The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Happy Friday, everybody. Welcome to Squawkbox Europe. I'm Steve Sedgwick with Ben Boulos in London and Annette Weisbach at the absolutely key and pivotal Munich Security Conference in, funnily enough, Munich. These are your headlines. AI disruption fears hitting equity markets once again, all over the place, all kinds of sectors falling. It sent the S&P 500 and the Nasdaq lower. As I say, all kinds of sectors, transport, real estate, software stocks, all under pressure over AI concerns.
Global leaders gather here for the Munich Security Conference as US allies here in Europe chart a more independent course. The EU Commissioner for Defense and Space, Andris Kubilius, is telling CNBC the continent is pushing ahead.
We need to do our part of the job. It demands investment, it demands production, and as the European Commission, we are pushing forward this agenda.
L'Oreal fourth quarter sales miss expectations as strong numbers out of the US and Europe fail to offset weakness in China, sending US listed shares sharply lower. CEO Nicolas Hieronimus tells CNBC he's confident the French beauty giant will bounce back.
There's a lot of moving parts in China, but we feel confident that, again, if you innovate enough, you can seduce the Chinese consumers.
Oh, nice to see you all, everybody. There are some... Morning, Ben.
Morning.
There's so many extraordinary things going on. I'm a student of markets. I'm a former practitioner of the markets. I'm obsessed by markets. I make no bones about it as well. And I'm loving the way that the market is moving through its phases at the moment. You talk about in rugby and in sport, you move through the phases and you build up towards getting a score or what have you. I mean, the market is moving through its phase at the moment. Think about it. Last week, it was all about software stocks getting sold off because of the concerns about the Claude co-work. And now everyone's just looking for victims left, right and centre. So it's moving into wealth management. It's moving on to the banking sector. It's moving on to real estate. It's moving on to transport. I mean, that wasn't the first one on everyone's list, was it? And it's just moving through the phases. What I think is really, really interesting is that it's doing so in a pattern where it's looking at the third derivative. It's not saying what's the immediate benefit of AI anymore, which it did originally. Now it's going, yeah, but if this happens and then this happens and then that happens to logistics, then we don't need as many people and then that's going to happen. And it's very interesting because the market that I know, that I love, normally goes through one or two phases. It looks at the next thing or the next thing after that. It very rarely goes all the way down the line and looks at the worst case scenario.
Yeah, and it's the point that you make there about the sectors that are being affected. It's like dominoes, isn't it? And who would have thought that something as traditional as freight and transport would start to be feeling the effects of it? And I think the key to companies fending off the worst of this AI tech sell-off is to show how they can use it to boost their revenues and their profits rather than fall victim to it. Because the other thing that intrigues me is when they talk about AI leading to job cuts, surely that means a lower head count. And as long as you can make sure your offering as a business still has relevance, a lower head count means lower operating costs.
There's a lot in there. And we're going to ask, actually, we've got a brilliant CFO coming up in a moment. Katie Murray's getting good from NatWest. We'll get an AI question to her as well, because I know she'll have an answer. In the meantime, US markets, let's have a look at this. It was the Nasdaq that fell off. It's now 6% off its record high. So it's beginning to get a head of steam to the downside, moving towards correction territory. But as we know, some of the rallies have been vicious, as indeed they were last week. Software stocks, I want to do those very quickly. We were down on Shopify by 6.8%. AppLovin, that was the one that got really a lot of downward momentum, 19.7%. Palantir, again, a very highly valued stock. Well, last time I looked, over 100 times forward. Wow. It's a high place. Moving on to the banking sector as well. This is where we saw the sell-off with Morgan Stanley. JP Morgan was another one down, but Citigroup 5.3% easier as well. As I mentioned, real estate, and that's what Ben was saying about if you have less employment, then you need less real estate if you're a company as well. So real estate companies, CBRE, that was one that caught my notice, 8.8% higher, a big part lower. And again, a lot of people asking, well, how are these companies moving so aggressively when actually there wasn't such new news about the AI story? Logistics, another one I mentioned. I mean, extraordinary. Some of the big names there as well. RXO down 20.5%.
Let's have a look at what's happening on the Asian markets, and they are, for the most part, well, in fact, across the board, tracking those losses on Wall Street, all trading lower. The Asia-Pacific markets, fears over artificial intelligence having an effect there. We're seeing Japanese and Indian IT stocks down, names like Trend Micro down 5%, NS Solutions dropping 2.5% as well. In India, Tata Consultancy Services fell 3.5%. In China as well, we've seen tech stocks fall, all of that pulling the main benchmarks in the region into the negative. Let's take a look at the expected open in Europe. This is the picture that is being anticipated. Fairly flat for the stocks overall, but London and German markets expected to open just marginally into the positive. Some follow-on from the previous day. The main sector gainers in the previous session, telecoms, food and beverage. Main sector laggards were banks, construction materials and tech.
Great, thank you, Ben. I'm just looking at these NatWest numbers, and there's some really, really encouraging stuff in there as well. And in fact, I'll mention a couple of them as I get to Katie Murray, who is the CFO of NatWest Group as well. Because, Katie, I almost feel emotional when I'm looking at a British bank turning a ROTE of 19.2%. It's something I didn't think I'd ever see, certainly from the financial crisis as well. Your cost-income ratios under control, your impairments look incredibly low as well. You must be very happy.
No, thank you and good morning, everyone. Look, very happy. 2025, it's a really strong set of results. Profits, returns, dividends, they're all up. But importantly, it's really grounded in our customer support and the activities of our customers as we've really delivered a great print this morning.
Katie, you know better than I do that if you look from the outside, you very often see doom and gloom about the UK, doom and gloom about the UK consumer, the economy, the government finances as well. Does it appear that way to you from where NatWest is sitting?
No, it's interesting in that outward look. It doesn't really match what we see. I guess as we look at things, we definitely see signs of optimism. And probably the best way to demonstrate that for you this morning is actually to look at what's happening on our balance sheet. If I look at this year, our lending's up 5.6%, our deposits are up 2.4%, and our AUMA is up 20%, in the year. And those together just kind of combine to sort of say, actually, they're really working as a consequence of the deliberate actions and progress that we've been taking with our customers. And that can sometimes go at odds with the narrative that we hear externally, because what we can see from our customers is they're active, they're making decisions, they're buying new homes, they're investing in their businesses.
In terms of the forward look, and I was very interested that you're giving some pretty forward-looking ROTE levels and cost-income ratios as well. So in order to give out 2028 ROTE figures as well, you must feel pretty confident about the sustainability of what we're seeing and perhaps defying those concerns about a cycle. Because even with the robust picture you're talking about, it wouldn't be uncommon for UK to enter a lower cycle at some stage, certainly on the housing market, which continues on a countrywide basis to be robust, albeit with the South East under pressure.
Absolutely. So if I look at our 2028 ambitions, we've sort of said our client assets and liabilities grow by more than 4%, cost income ratio less than 45%. As you say, that ROTE greater than 18%. That was the strongest of any UK bank and holds its head up at the very top of any kind of European bank as well. And all importantly, combined with the capital generation of greater than 200 basis points. We don't do targets casually. They have a huge amount of debate within the organisation. And obviously we put out targets that are stretching, but ones that we really believe that we can hit. So we're comfortable with that. And again, it comes back to our kind of growing confidence in what's happening in the economy and that growth agenda that we really have within the bank.
Katie, it's Ben jumping in here. Steve and I were just talking about the impact of AI and the disruption that we've seen it cause in so many sectors, including wealth management. I just wonder, given what we've seen, the stocks, wealth management stocks tanking in the US on Tuesday, how you feel about that recent announcement to buy Evelyn Partners?
We're really excited about Evelyn Partners. We're going to be creating the UK's #1 private bank and wealth manager. clearly we talked and debated about AI as we were doing this acquisition. AI has been a big delivery for us, and we can get into that more in a moment if you like. And so we'd expect really to see that AI really helping augment the delivery that we make to our customers. We think it's a really attractive market. It's got considerable potential. And we can see the benefits of AI really just making it more efficient, bringing better product to the customer, and really working with our relationship and private banking managers in those moments that really matter when you're making a big financial decision. But we see it as a real benefit to us and a real sort of combination of the delivery that we think that we can really deliver with Evelyn. So very excited by it this morning.
And just keeping with that topic, just a quote from the Wall Street Journal, the financial tech firm Altruist has an artificial intelligence tool can create personalised tax strategies by interpreting financial documents without manual entry. What role does that leave for an organisation like Evelyn Partners?
So I guess when you look at something like that, and there's other tools that you can use at the moment to that will help you. There sounds like a very exciting kind of tool. But as you get all of that pulled together, and what we find with our customers today, when you want to actually make that decision that you've received some money or you've left your job or you're getting your pension, that first kind of level of analysis is great. It can be very, very high quality. But ultimately, we find that people, each of us, want to then sit with someone and go, right, let's shoot. Do I really understand? Do I really agree? Is it actually how I want to live, what I want to do? And then we kind of work out how we actually then really implement and affect the strategy that will have been worked out. So we see AI something that will go in tandem with those kind of bankers and advisors that we have within the organisation.
One thing I suppose that won't change in a world that feels like it's changing ever more quickly is people's desire to buy and own their own home. And we had Ana Botín from Santander on the show just last week, and they were announcing a new 98% loan-to-value mortgage for first-time buyers in the UK. Does NatWest have any plan to offer anything similar to compete on that front?
Well, it's been interesting with some of the changes that have come through in regulation. We've definitely seen an increase in the kind of levels of loan to value that we've seen. Overall, the book is still averaging at the new business of about 76, but you can see in the depths of our numbers that there's more going on in that above 90% space. And I think the regulator has really tried to kind of work out how they can make homes more accessible for people as we go through. But importantly, I think as we look at the total part of the book, what you will see, it will be a smaller part of the book as we go forward from that. And with the strength and the size of our mortgage book, it's something that we will look to. I'm not saying necessarily 98%, but we can certainly see that we're taking on mortgages at a little bit higher level than we would have previously because of some of those changes in regulation as well.
Katie, we've already referred to liabilities and credit impairments as well, but I hear small and medium-sized businesses, a lot of, not the mega corporates, but a decent-sized companies crying out for better government as well, better policy as well. They're saying that they're being stifled on all kinds of fronts, whether it's NICs and what have you as well. Your loan book is very important to you as well, your corporate loan book. I just wonder what you're seeing on that front.
Very, very important and interestingly very well performing. If I look at our cost of risk in this last year, it was 16%. We are guiding to slightly higher next year, but that's really about the change in mix and more of a return to kind of normalisation. Look, I think what all businesses need is stability in terms of government policy and to know the rules and the channels within which they're working, and then they're able to work within that. As we look at our strategy going forward from here, it's very much about how do we help grow the books, and one of the most important parts of our business that we have is that real mid-market. We're the number one bank for business within the UK, and we spend a huge amount of time in that mid-market space, which is at the smaller to medium-sized kind of end of businesses, to really work with them to say, actually, how can we work through the opportunities that are being presented, but also deal with some of the challenges that have also been presented in terms of their financials.
Katie, I'm going to ask you a question I don't know if you're going to want to answer, but do you think there's a lack of competence at the Treasury as well? I spoke to someone as senior as you, maybe even more senior than you in British finance as well, and they said that the Treasury is just not listening to their warnings about a lot of the tax policies and the changes as well. And actually there is a level of comprehension which isn't where it needs to be as well. You just mentioned that companies need to have stability and know the rules. My takeaway on Chatham House conversations is that the Treasury is the problem because they don't actually understand the ramifications of a lot of what they're enacting.
I think what I'd probably say is let's leave the politics to the politicians, and I'm going to focus on the day job of really working with our customers and making sure we deliver these really ambitious targets that we've set for 2028.
And I'll leave the politics aside, but are you worried about the level of comprehension of policy, of actual enacted policy in the Finance Act, i.e. the budget, for actually what it means for society?
Well, I think when we look at what we've tried to put out this morning in terms of our numbers, and we see the delivery that we're getting as a result of working with our customer base, I do think there's a good path that we're continuing to work our way down.
Katie, I just want to get your thoughts on this fund that NatWest is part of, this £11 billion fund to help UK businesses expand into foreign markets. Just tell us a little bit more about that.
So when we look at what we do, obviously UK domestic bank, but we have very strong nexus in terms of making sure that we can help our UK businesses as part of their export of their goods, the international activity that they do through our CNI business. We are very strong in a lot of those kind of big international foreign exchange transactions that you see going on. And what we're trying to do is to make sure that we are leaving sort of ring-fencing money that's able to kind of help businesses develop, whether that's in things like international trade finance, foreign exchange, or some of the capital markets activity. Because the UK is very important, not just internally, but also for its global activity. And we know many of our clients need to work globally as well as just domestically.
Katie, you're the lady I love to speak to because you hold the purse strings as a CFO, as important as a CEO is as well. And so the capital allocation is very interesting. You found the money for your company to go and buy Evelyn, as you and Ben were just talking about there as well. But I do note that actually, even though you've had an extraordinary rally, and congratulations on the rally in the share price over the last 12 months plus as well, there has been a bit of a downtick recently for a lot of the banks, nothing particular about NatWest as well. And your price to book and indeed your price earnings ratio are not actually that demanding as well. Is there an opportunity to increase the returns to shareholders or to increase the buyback more aggressively?
Well, as we look at the returns and the dividend we've announced this morning, it's 51% up on last year. And if I add on the buybacks that we've done, we're actually distributing 75% of our generated profits. That's an extraordinarily high level of return. At the same time, we're committing 2.7 billion in terms of the purchase of Evelyn. We've always been really clear, Paul and myself, is that our aim is to make sure that we distribute excess capital back to the shareholder, and it's something we're very focused on doing. And I think at that 75% print for 2025, it's a very strong number. And what we know that in time, as Evelyn kind of comes into the business, it will continue to enhance the returns that we're able to make to our shareholders as well. So I think it is something that we're very focused on in terms of that capital allocation.
Yeah, and Katie, in days past, we might have had conversations about branch networks and what have you, but I had a very interesting conversation with the chairman of one of the biggest upstarts in Davos as well, about the UK banking sector as well. And some of the non-traditional players feel they've really got wind in their sails as well. Do you have a competitive enough offering, and do the rest of the UK banking sector, traditional banking sector, to face down the threats of the Revoluts and others?
I think that we do, and I think that what you've really seen is over the last kind of 10 years within the kind of the scale banks in the UK, that we've really changed in terms of that competitive operating. And I would sort of say that a lot of the startups have been actually really good for us, because it's kind of held up a mirror and say, guys, you need to get into this. And I actually think our offering is incredibly competitive. And you can see that in the way that we're able to grow the balance sheet and our customers coming towards us. And we continue to evolve. If you look at something like the home buying journey, we've announced a partnership with Rightmove this week, which actually brings it all that just much closer together in terms of removing friction in terms of your home buying journey. And we'll continue to see that move more and more. I think in AI, in terms of some of the changes there, you'll see us at the very forefront of a lot of the banking developments within there. So we would say that, yeah, we feel that we're definitely able to compete appropriately and with others as they also come into our space.
Katie, absolutely love this conversation, and thank you so much. You have such a great analytical mind. I can get to go to all kinds of weeds and that, and you're so well prepped. So thank you so much indeed. And I understand your deft political skills about the Treasury questions as well. I much appreciate it. Katie, nice to see you. Katie Murray, CFO of NatWest Group. Coming up on the show, not worth it. Oh, that's harsh, isn't it? Not worth it. L'Oreal shares come under pressure in the US after China's sales come in weak. We're going to break down the numbers with Charlotte, who did a terrific interview. That's coming up next. Plus, EU leaders have broadly backed an action plan, thank God for that, following yesterday's retreat. And we're going to be joined by the Latvian Foreign Minister, with Europe looking to boost its defence capabilities. More from the pivotal Munich Security Conference at 7:45 London time. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
L'Oreal sank in US trade after North Asia sales came in 5 percentage points below what analysts had penciled in. Overall revenue growth came in less than expected too, up 6% in the fourth quarter at more than 11 billion euros, although North American revenues beat expectations. Charlotte joins us with more. Charlotte, just run us through the highlights from this.
Yes, with those results, you had Estée Lauder reporting recently, so of course a smaller competitor, but that had double-digit growth in China. So that added pressure on those results that we're expecting from L'Oreal, and certainly these North Asia results are below expectations, up 0.6% in Q4, 0.5% for the full year. And as I said, that North Asia, excluding travel retail, was up 4% in H2. So they did see an acceleration in the second half, but certainly not the results that they were expecting for Q4. So that will be one of the disappointments, because we saw in other areas things were better than expected. North America up 8.6% in Q4, Europe up 6.6%. So, Q4 is usually one of the strong quarters for L'Oreal. It's the festive season. People get perfume sometimes at Christmas. But overall, you're looking at the divisions. You have professional products that were up 7%, luxury up 4.5%. So that was interesting, because luxury, of course, is one that was the strongest after COVID. A lot of people buying some of the more expensive products there in terms of makeup and perfumes. But they saw that consumer product, when things were tougher, took the lead again. So now we see luxury slightly coming back there in that Q4 quarter. Fragrances being a major driver for growth, in particular, as we've seen over the past couple of years. So overall, they say e-commerce is also a big boost. It grew double digit last year, passing the 30% mark. So I had a chance to catch up with the CEO of L'Oreal, Nicolas Hieronimus, exclusively to discuss over the whole result and how 2025 looked.
For us, 2025 has been a very defining year. First of all, I think it has shown the resilience of L'Oreal in a very volatile environment with tariff, geopolitical tensions, and lots of changes in the consumer mindset. And despite that, we've, as you mentioned, grown above the market, and more importantly, accelerated quarter after quarter. And I tell you, we intend to continue to accelerate. But it was also a very defining year, and I guess we'll get back to that, because we have invested tremendously in the transformation of L'Oreal, both on the tech side, in IT, but also in M&A, with, amongst others, the acquisition of Caring Beauty. So that's, I think, a year that puts us in a great position to accelerate into the future. Now, going back to your question of what were the key accelerating factors, I think for me, what I want to highlight is the acceleration of our two biggest countries on the second half, whether China, that moved for us from +1 to +5 between first and second half. That confirmed the acceleration of the market. It's not, it's a modest acceleration, but we've outperformed it. So that is very promising for the future. And also our acceleration in the US, where the market has remained dynamic, but we've increased from 2 to 4%. Particularly with an acceleration of our mass market division that was lagging behind, and from our dermatological beauty division. So China was more a luxe story, and the US dermatological beauty and mass market acceleration. And the final element, before you have another question, e-commerce is a key factor for us. It's 30% of our business now. We grow double digits faster than the market, and that's really where most of the market growth comes from. And our capacity to win in e-commerce is a very important element of our performance.
Right, so let's dive into all this, because Q4 kind of reflect a lot of the trends that you just mentioned there. North America up 8.6% in Q4 like for like, so the strongest region this quarter. it wasn't the strongest region overall for the year. So is the Q4 quarter a reflection of the trend that you expect to see in 26 with North America really coming back to the
Well, we intend to continue on that momentum very clearly because we had, I mean, if I look at my 4 divisions, fantastic performance of professional, and hair care is overall a very strong category for us. We had a pretty solid L'Oréal Luxe performance across the year, but as it's mostly driven by fragrance, it has accelerated in sell-through at the end of the year. And we're a bit unhappy in the beginning of the year with our mass market performance, which was very dependent on makeup. So we really doubled down on innovation. And so for LDB, where I think CeraVe lacked a little bit innovation at the beginning of the year, so our famous beauty stimulus plan, where we really increased and stepped up in innovation on all divisions, fragrance too, by the way, has really led us to accelerate on second half, and that's what makes me ambitious for 2026.
And that was Nicolas Hieronimus, the CEO of L'Oréal, speaking to me on their full year numbers. Of course, 2025 was a year where they announced the biggest acquisition in their history by buying Kering Beauty for 4 billion euros. So we talked about their plans on growing, the brands that they have there, whether it's Creed, the perfumes, but also Balenciaga or Bottega Veneta or Gucci eventually. So they say, that will give them lots of opportunity to grow things there. It was interesting to hear actually from the Kering CEO a little bit earlier in the week saying it's good for them as well, growing the exposure of their brands and the opportunity that this brings as well. 2025 is also the year where L'Oréal doubled their stake in Galderma, the injectable company for beauty, with a stake now to 20%. They're looking more and more in this kind of area as well, in a wider kind of view on what beauty looks like. So they have outperformed the market last year. They said they want to accelerate in 26 as well to continue to outperform the market. And they've announced a dividend of 7.2 euros per share, up 3% compared to last year.
Superb work. Thank you very much indeed for that. We'll come back to you later. I'm just looking at this because I'm worth it. I mean, because our writers still use it all the time. Do you know when it was created?
That's a long time ago.
It's a long time ago, yeah. It's 1971, tagline for L'Oréal Paris, because I'm worth it as well. So I don't even know if they're still using it, but because I'm worth it, because you're worth it, because we're worth it, broadening the message. There you go. It was a rallying cry for women's emancipation, apparently. So there you go. Thank you very much. European futures to break look like this. We're very robust considering where we came from yesterday on the US equity markets. We'll be back after a short break.